Hello, and welcome to a Money Week webinar with Julian Bishop, co-lead portfolio manager of the Bruner Investment Trust. I'm Rupert Hargreaves, deputy digital editor of Money Week. Thank you for joining us, Julian.
Pleasure to be here. Thank you.
So first, I'd like to start with the history of the investment trust. So could you tell us a little bit about Bruner's history and how we've got to where we are today?
Sure. So the Bruner Investment Trust got about 500 million sterling in net assets. The investment trust actually dates back to 1927 when Sir John Brunner sold his business. It was a chemicals business, sold it to what became ICI, and the trust was set up to manage the proceeds. And the family, the Brunner family, they're still involved. They own about 30% and they have board representation. So that's a little bit about the history of the trust. Just so you know what we do, we invest in listed equities only, quite an unusual benchmark. We're 30% UK, 70% global. So the idea is that we're a one-stop shop for the UK investor who wants a portfolio which can form the backbone of their equity investment. So you have all the great value in the UK market, plus the quality and growth in Europe and the US, etc. Not to say that that's mutually exclusive, but that's generally the way it works. Got about 60 holdings at present. And one thing that we're well known for is a long history of dividend increases. So we've actually got a 51-year record of increasing the dividend of the trust every year, dating back to 1972. Also known for the consistency of our performance. So we've beaten the index for 4 consecutive financial years, and we're on course to make that a 5th, despite a very wide range of market conditions over that period. And our style is to have a balance between quality, value, and growth. So we have a very strong preference for quality, and we can talk about what that means, but we also have a determination not to overpay. So we have a philosophy that has served us very well. If you look at the peer groups, we're towards the top of the global equity peer group over longer periods with relatively low volatility, and we firmly believe that slow and steady wins the race.
Could you give us a bit more insight on that quality and value slant that you have? What are you looking for when you are looking for positions to add to the portfolio?
Yeah, so we have a strong preference for quality, and a lot of people have different opinions about what quality means, but the way we would see it is value creative businesses. So businesses that have high returns on invested capital, businesses that we think have sustainable competitive advantages, so some sort of unique market position or in a favorable market structure, and companies that allocate capital in a very sensible way that's attractive for shareholders. So those tend to be the sort of linchpins of our holdings, what we look for. But then simultaneously, we don't want to overpay for businesses, so we're very mindful of valuation. And when it comes to valuation, we tend to be pretty laser focused on free cash generation. So we tend to sort of look past the P&L, look to the balance sheet, and then to the cash flow statement to see how much cash a business generates that can be safely returned to shareholders or invested into value creative activities.
And that's another part of your process as well, I think, is looking for companies that can grow their dividends as well as grow earnings at the same time.
Yes, absolutely. So we would generally look for companies that are growing as much as possible with our sort of quality and value framework. I think if I look at our forecasts at the moment, we would expect our companies in aggregate to grow profits in the region of 10% next year. And as those profits grow, we're very mindful want to make sure that those profits can be translated into cash profits that can then be returned to shareholders as dividends. So the dividend is, certainly part of the total return, but a reasonably small part of the total.
And have you always got that dividend track record in your mind that the trust has managed to achieve over all these years?
Yeah, absolutely. So we've got this 51-year record of increases. Certainly don't want to break that anytime soon. Don't expect it to break. One of the advantages, by the way, of an investment trust is that you can hold income in reserve. So you can set aside some income for a rainy day. So if there's anything that happens from a macro perspective, we can dip into that to make sure that the dividend payment is met. But absolutely, if we have a growing set of high quality equities, we would expect the dividends to grow alongside that. And the dividend requirements it's there, but it's not too onerous. It doesn't push us to do foolish things as can happen. But yeah, we are very much determined to make sure that dividend record continues.
And it's interesting because I did look at the trust, and it's on the last count was a 2.1% dividend yield, which is something might argue is not the highest in the world, but I think you might argue that it's not high yield that matters; it's the quality of the yield that matters.
Yes, absolutely. So one thing to mention perhaps on dividend yield is that dividends in the United States particularly tend to be relatively low compared to other parts of the world. So the preferred method of cash return to shareholders is stock buybacks. And the way stock buybacks work is they reduce the number of shares in any company in circulation. And it means that the profit of that company is divided by fewer shares. And that means that generally buybacks should lead to increases in earnings per share and therefore dividends per share if they're held level. So global funds tend to have a lower dividend yield than UK funds, for example. I would always try and push people towards looking at total return. So for us, the total return has been, average over a long period, about 10% a year, and about a quarter of that has come from the dividend. So dividend is very much only part of the story. And I would also say that our dividends tend to be very well covered. That the business models that we have tend to be, as I mentioned, higher quality than the average. We tend to invest in companies with strong balance sheets. And if you have a very, very high dividend yield, it's normally telling you something, about the caliber of those businesses. So, it's funny in the bond world, for example, we call high yield bonds, we call them junk bonds. And I think you can say the same to a certain extent about equities. Normally, if you've got a very high yielding equity, it's because there's no growth, or there's a concern over the sustainability of the business model, or it's very levered. I mean, that's one thing you will often see, is that high yielding equities tend to come from sectors where a lot of leverage is involved. So it might be a bank, it might be a utility where there's a great deal of debt there, which means, of course, that the risks are higher. So I would always encourage people to think about total return, think about the quality of their investments alongside the dividend. Having said that, our shareholders appreciate having that dividend. It's paid quarterly. It's a regular portion of income. I think having some sort of dividend requirements does two really useful things as an investor. So it focuses us on free cash flow that can be returned to equity shareholders, which is really the input into any DCF. So that's, focusing on what really matters. And secondly, it does enforce a very important valuation discipline on any investor. So, if you're talking about very, very expensive equity with a very high price to earnings ratio, it's not going to have a high dividend yield. So in that case, it's a good example of having a dividend requirements, even if it's reasonably low, enforcing a useful valuation discipline on the manager. So I'm glad it's there, but I'm equally glad it's not too onerous. It's not too high. It doesn't force us to do foolish things. This doesn't force us into low quality, low growth equities. So it's all about balance for us.
So a little bit of one thing is nice to have, but it's not essential really.
Yes, exactly. But just to reiterate, we want to keep that record alive. We like to invest in companies that do return some cash to shareholders, but it's not the be all.
So on that point, that brings me nicely onto the fact that the trust switched several years ago, I believe, to an sort of an all-weather approach to growing and protecting investors' capital through all environments, rather than sort of breakneck growth or income or anything like that. I'd be interested if you could talk a little bit about why the trust has followed this approach and why you think it's a better route to go down.
Yeah, so we describe our approach as being an all-weather approach. So the idea is really it's something that you can buy and hold, something that can form the backbone of any investor's equity portfolio, something that's prudent but opportunistic simultaneously. And what it means is that the fund doesn't really take any large views on, for example, investment styles or currencies or regions or sectors. So at the moment, we have 59 holdings, and each has a unique set of characteristics. Each offers a high quality, growing cash flow stream. And we try to make sure that there are as many uncorrelated risks in the portfolio as possible. So we're not betting the farm on anything. And we think that's a very prudent way to invest. And if you were to undertake, a relative risk analysis of Bruner, you would see that most of the risk comes from stock selection. So if we're doing well, it's not because we're overweight growth or overweight healthcare. It's because we have a really positive view of the GDP outlook, for example. It's because we've selected our stocks well. And Christian and I, so Christian is the other co-manager of the portfolio. We're of the firm view that we're not macroeconomists. We're microeconomists. We're focused on companies, on competition. We're focused on industry structure, focused on valuation. And by being good at that, we've been able to deliver consistently good investment outcomes in a way that not many other people have been able to do. So as an example, in 2021, pretty much all growth managers did very well relative to the benchmark. But then in 2022, they got killed when banks and oil stocks roared back, and vice versa. But we outperformed in both those periods, and we're outperforming this financial year as well. So really, Bruner as a portfolio is intended to be resilient on a relative basis, whatever the weather. So I like this all-weather tagline. Within that context, we have this preference for quality, but we marry it with this determination not to overpay. And I think that's allowed us to avoid some of the extremities that have been seen in markets over the last few years, where you've seen the wild swings in what's worked and what hasn't.
I think that point is worthwhile focusing on, is that you said you outperformed really for the past 2 years, and then you're doing quite well this year as well.
Yeah.
And I was just wondering, could you shed some light on why you think that is? Because obviously the past 2-3 years have been a very turbulent period for investors, and any fund that's been able to navigate that storm, as it were, is clearly doing something right.
Yeah, but I think it comes down to that sort of stock selection without taking too much style risk, factor risk, regional risk, etc. So some people describe themselves as growth investors, and we want as much growth as we can possibly have. Some people describe themselves as value investors. We want as much value as we can possibly have. Some people describe themselves as quality investors, and we want as much quality as we can possibly have. But we sort of triangulate for all three, or respond to market conditions at the margin to make changes to the portfolio. So, I mean, reductio ad absurdum. If you're a growth investor, and it so happens that all great growth companies trade at 1,000 times PE, is that going to deliver a good sort of outcome for your clients? Probably not. And at the opposite end of the spectrum, if there's a resources company, sort of traditionally lower quality sector, and that's trading at a PE of 3 and it's solvent, then it would probably be preferable to move into that. So I think we have an approach that allows us to be flexible enough to move when valuations become uncomfortable, for example. So in 2021, a lot of the best-in-class quality growth companies, became pretty unpalatably valued. Growth managers kind of had to stick with them because that's what they say they do. We were able to rein things in a little bit and transfer some of those funds into areas that we thought were more appropriately valued.
So I'm just looking at your latest fact sheet, and you've got a 41% allocation to North America, and then 27% to Europe, and 24% to the UK. Would you attribute exposure to those regions as one of the reasons why you've been able to navigate the storm more, that more global focus rather than just say a focus on the US market as so many investors do?
Yeah, I think there's a sort of overlap with everything I just talked about, actually. So, at the moment, we're slightly underweight the UK, for example, at the moment. That's been helpful this year. But actually, if you look back over 3 years, the UK market's performed pretty much in line with the US market, because the US market had this sort of big collapse last year, and then the UK held up a lot better because it hadn't seen sort of those same valuation excesses that the US market saw. So I think what's helpful is our ability to move and be opportunistic in that respect. The US market's a terrific market. I mean, it's, in terms of quality and growth, it's got all that in spades. But quite famously, it trades at a bit of a pretty substantial premium to, for example, the UK market. So it's our job just to sort of work out, on balance, where we think is best. I mean, we never allocate per market. We're never saying, oh, now it's time to go overweight the US. But I said valuations in the US have come down in aggregate. Some of the names that we're more interested in will have come down in multiple, come down to free cash flow yields that we think is attractive. We'll move into that area and take some holdings. So yes, it's useful for us. And I think one of the great things about being a global investor is that you can do that. So you can move to wherever you see the best opportunities. You're never constrained by geography. You're never constrained by sector. We can simply buy shares where we see valuations being attractive in the context of quality and growth, and vice versa. We can sell where we think things are getting out of hand.
On that point, your allocation to the UK is slightly lower than your benchmark weighting. Benchmark's 30%.
Yeah.
Our allocation is about 24, I think,
Yeah.
based on the last fact sheet.
Yeah.
So on the basis that you're looking for valuations, is that because you don't think UK equities are particularly attractive on a valuation basis?
You would say on balance in the context of quality and growth, yeah, that would be a sort of natural conclusion to rate. And again, that's not a sort of wholesale view on the UK market. We're looking on a bottom up basis for the best ideas we can find. And I would say the UK market is, cheap in inverted commas. It's got low PE, it generates lots of free cash in aggregate, got a great dividend yield. But the quality is, I think, quite a bit lower than the US, for example. And certainly the growth absolutely is quite a lot lower than the US, for example. And so at this point in time, yeah, we find better ideas elsewhere. Although I would note that we have been adding to the UK. So, we have actually topped up some of our UK holdings recently, bought a couple of new ones. So, again, in the context of this sort of quality, value and growth framework, the UK, we do think, is looking a bit more interesting. But we're never making sort of wholesale comments about the UK market. We're always looking for individual companies that we can invest in. And we always think of ourselves as business owners. We're not market owners. We're running individual businesses. And, in this multinational era, quite often where a stock is listed doesn't really have much to do with the actual nature of the business. So some of the businesses that we bought most recently in the UK, for example, their largest markets are actually in the United States. But we do notice, it used to be the case, I think, that the UK market was cheap, in inverted commas. That was mainly because of composition, because you have a lot of banks, you have a lot of resources, a lot of energy names, sectors that are traditionally have quite low valuations. But increasingly we're noticing that some of the higher quality UK names would trade at a bit of a discount to their counterparts, the most obvious counterparts that are listed in the US or in Europe. So at the margin, that's been tipping on investment decisions towards some UK names.
Okay, thank you for that answer. So I'd like to pick up on one of your holdings is Shell, and it's one of your top holdings. I was wondering if you could give me a sort of or give our viewers a sort of idea of how Is that a representative idea of a UK opportunity that's high quality and is undervalued, and you want to own it in the portfolio compared to a US opportunity?
Um, it's sort of an example. So I would say probably the lower quality end of the spectrum for our holdings. So I mentioned balance. I think generally it's tough to claim that any oil and gas company is high quality. They don't tend to have great returns on invested capital. They don't tend to grow very much, and that's actually something we've been speaking to management about. We don't want them to grow. We want them to generate cash. We don't want them to invest in new capacity generally, because we would like, in a way, a higher oil price. That's obviously great for the company. Also think it's good for society. If there's a higher oil price, that provides an umbrella under which renewables can flourish, and we think that's important. I would say that the Shell, it doesn't really have much to do with the UK. It happens to be listed in the UK, but very few of its assets are in the UK. Most of its sales, I think its largest market is America, actually. So it's a good example of a multinational business that happens to be listed in London. It used to be also listed in the Netherlands. So it's not really representative of the UK in any shape or form, but it is listed here. One thing we do notice is that Shell, we have one other energy name, Total, listed in France. These European energy names tend to trade at a pretty significant discount to the American listed names. So if you were to compare those, for example, to Exxon in the States, they trade at a much lower multiple and have a much higher free cash flow yield for no clear and apparent reason. So I mentioned this ability for us to go wherever we like. That's, we think, a pretty stark example of where you get better value on this side of the pond. So yes, our sort of allocation to those industries is to the UK and to France rather than to the States. I would say that at the moment, energy is our sort of favoured lower quality sector. So just to perhaps touch on some of the reasons why we think there's some good investment opportunities there. I think largely it's because we see this incredible discipline across the industry in response to environmental concerns, which means that there's just far less exploration going on in the industry than there ever has been at any point in history. So there's less capital expenditure going into the oil and gas industry than there has been for a very long time. And I think there's a determination for that to hold. And what that means is that supply's a bit tighter. It's good for commodity prices. As I mentioned, I think that's good for renewables, but it's also good for profitability. So at the moment, these companies are generating absolutely enormous free cash flow yields. And because they've been making a great deal of money for the last 2 or 3 years, they've also been able to improve their balance sheets a great deal as well. So they used to be encumbered by what we thought were uncomfortable levels of debt, but that's now changed. The balance sheets are a lot stronger, which means they're in a position where a lot of that free cash now can be generated and returned to shareholders. There's also a very active debate about terminal value, the risk of the big stranded assets and so on. And we think, I say this regrettably from an environmental standpoint, but we think that oil and gas remains pretty critical for the existence of society for the coming decades. I've read a great deal on energy transitions, and it's going to be very, very hard, I think, for society to pivot towards net zero. It's going to take, literally decades. And gas in particular, I think, will be necessary for quite a long time yet to come. Both Total and Shell have very strong positions in natural gas.
You wouldn't say it's a major theme for the portfolio then, energy whatsoever?
It's not a major thing, no. I mean, we're long-term believers in the energy transition, but there's a lot of capital going into electricity generation, for example, which has meant that the returns on a lot of renewable energy projects has become very, very low indeed. Whilst the opposite has happened in oil and gas. So we have those two holdings. We're a little bit underweight actually the sector. Those two holdings, Shell and Total, say are a little bit different from our typical holdings. And the reason we have them is because of that capital discipline and the extraordinary amounts of cash that those businesses are throwing off at present. But very much towards the value end of our portfolio. Certainly not what I would describe as sort of higher quality names.
Right, okay, thanks for that explanation. And then, so one interesting theme that seems to run through the portfolio is non-bank financials, which seem to make up a large percentage of the top 10 holdings. Could you give us a bit of a rundown on these companies and why you like them?
Yeah, so within the financial sector, I mean, when people think of financials, they mostly think of banks and traditional insurance companies. But beyond that, there's a wide range of diversified financial businesses, each of which have their own drivers. And we quite often find what we think are terrific businesses in that mix that tend to trade at pretty reasonable valuations. So I'd highlight three. I'd highlight Visa, just look at them as the holdings, AJ Gallagher, which is an insurance broker, and Charles Schwab, which is a discount brokerage listed in the States, sort of like the Hargreaves Lansdowne of America. So yeah, so those are three of our names that we have. I think they're all in the top 10 at the moment. I think a really good sort of combination of quality, value, and growth.
With a name like Visa, you said there, you just have to sit there and it grows year after year, just grows year after year. What's your average turnover across the trust? I mean, I guess the names like Visa you want to keep forever. But
yeah. So we try and buy everything with the mentality that we'd be happy to hold it for the long term. And I think that's a really important discipline. So it means that you're really focusing on what you think a company is worth. You're really focusing on how the company can develop and create value over time, how it can compound. You're not just buying it for a short-term catalyst or a slight re-rating. You're not just buying it because of noise. You're buying it because you think it's going to be a terrific investment for the long haul. So the turnover on the fund is pretty low. Last year, I believe we did about 14%. So that implies an average holding period of 7 years. You know, if you sort of invert that, I think it's a little bit higher this year. So the turnover is, you know, it's not zero. There is competition for capital within the fund. We want to be able to act if we see much better value over here, or if we think the valuation of this has gone up too much, or if we've made a mistake, and that of course happens. You know, it's inevitable, always regrettable, but inevitable. We want to reserve the right to change our mind. But on average, the turnover, yeah, is pretty modest. Say 15 to 20% would be the sort of core range I would guide you to. But we want to, when we buy anything, be reasonably comfortable that we'd be happy to hold it for the long term. So, you know, I think Warren Buffett said, you know, ideal holding period forever. You know, we try and take that sort of that approach. Want to buy the type of businesses where we would be happy to own them if we knew that markets were going to be closed for the next 10 years. You know, if we'd be happy to take these companies private. You know, that's the sort of mentality that we want.
And is it on that, using that mentality, is that why we see Microsoft today at 6% of the portfolio?
Yes, very much so. You know, long-term core holding been, you know, tremendously successful for us. It's quite a big index rate as well, actually. Microsoft, so the relative position size is some way below that, sort of closer to 3. But yeah, so it's a big chunk of the fund. Absolutely happy with that. You know, we've talked a bit about non-bank financials. Also, you know, love the technology sector. You know, there's some extraordinary businesses out there. But the stocks that we do hold tend to be at the more sort of sober end of the valuation spectrum. Certainly not interested in concept stocks, you know, but Microsoft's position, I think, in the enterprise is pretty much unassailable. You know, and again, coming back to that thing about market structure and competition, you know, Microsoft Office essentially operates with no competition. Windows itself, beyond Apple, which has a few percent market share, has, an extraordinary stranglehold, particularly in corporate computing. It's doing really well in the cloud, with Azure. So sort of that industry appears to be evolving into a reasonably steady oligopoly with Google and Amazon. So yeah, Microsoft generates lots of cash. Quite unusually for a big tech company, it pays quite a nice dividend, which is quite rare. So yeah, Microsoft today is the biggest holding in the portfolio.
And then I think it'd be interesting for our UK watchers who might not be familiar with United Health.
Yeah.
Give us a quick rundown of what this business does and how it makes money.
So it's a health insurer. So it's a US business. It's a health insurer, and it also owns some assets like clinics, doctor surgeries, etc., that help it to manage the health provision for its clients. So most people in the States, most people, have private health insurance. Somebody needs to manage that on behalf of employers. So most healthcare is provided by employers, and United Health do that. So they're an insurer, they take in premiums, and then they pay the cost of healthcare provision. And why it's developed into quite an extraordinary business is really, I think, down to their scale and their unique ownership of assets that allow it to provide healthcare services at a lower price than peers. So essentially, it's able to price very effectively compared to its competitors, and then it's allowed because it owns these healthcare assets. It's able to steer people to a lowest cost solution for a particular condition. So let me give you an example. So say one of its lives under coverage, as they call it, has a broken toe. There are certain circumstances in which you would go to hospital to have that dealt with. They can probably guide you towards a lower cost facility. To go and see a nurse, for example, in a primary care centre, which would be a lot less costly if you're attending a hospital. So because they have those assets, they're able to reduce costs and then pass the benefit of that onto their clients. So it's a good business in the States as well. This came in under Obama. There's something called the Affordable Care Act, which ensures the provision of good healthcare services to people who don't have private health insurance. So there's two things, Medicare and Medicaid. These guys are one of the primary companies that essentially arranges that on behalf of the government. So they're a massive company. They're absolutely massive. I think primarily because of scale, they're able to price really effectively, deliver really cost-effective healthcare solutions, whilst making a pretty decent margin and a good return on its invested capital.
Okay, thank you for that explanation. So lastly, we've seen the trust discount has raised between about 10% and 15% over the past decade. Over the past 2 years, we've seen a lot of trusts merge with peers, buy back shares, or even liquidate to reduce discounts. Is Bruner's management looking at trying to reduce the discount? What is it trying to do about narrowing this discount?
Yeah, sure. It's a very fair question. So for people who aren't familiar with investment trusts, they're bought and sold on the stock market like any share. So therefore the price is set by supply and demand. And there's a reference point in there, which is the NAV, net asset value. And that's reported daily. And the net asset value in our case, because it's all listed equities, is very transparent. It's just the sum of what the shares that we hold are worth, less the value of debts and a few of the sort of small adjustments. And it so happens that most investment trusts do sell at a discount to their net asset value. And Bruner's has generally been in a range of 10 to 15%. So at the moment, it's at the upper end of that range. So when I say upper end, I mean the wider range. So it's at 15% or 14%, I think, today. Most global equity investment trusts are in the same boat. So it happens. Why it happens is a bit of a mystery, to be frank. We're at the mercy of supply and demand here. But there are a few factors I can mention. I think in the past we had some discount investors, so people who would only buy when the spread was quite wide, and then they would sell when it narrowed. But what we're finding is that we've got more and more owners who are just buying on platforms and via wealth managers. They tend to be far stickier and don't play around with the level of the discount as much. In terms of what we're doing, so no plans to merge, certainly no plans to liquidate. The board's very happy, the family's very happy. We don't have a buyback policy, so we don't want to buy back shares. I think that's a short-term fix. Doesn't really alter supply demands over any long-term time frame. Obviously creates short-term demand, but not any longer. And we don't want to do that. You have to buy back shares. Obviously, you have to reduce the size of the trust. We don't want to do that either. So discounts there. All we feel we can do is get out and tell a story. So you can do events like this, do as much marketing activity as possible. We feel like we've got a really good story to tell. The performance is very, very credible. Pretty consistently beat the benchmark net of fees. I think the process philosophy of the fund is very sensible. Have this all-weather approach. We think there should be good demand for our shares. We think it can form the backbone of any UK investors' equity portfolio. So all we can really do is get our message out. Beyond that, there's not much we can do. But the actual level of the discount as well, it's just a bit of a frustration. It's always there. But I think from the perspective of anybody who's thinking about buying today, this is the wider end. I think it's a good opportunity. It's a free option essentially. If that discount narrows, then you benefit from that. And just to remind people, you're getting shares in some of the best companies on the planet at a discount. You're getting a higher dividend yield, a higher free cash flow yield than you would otherwise get because of this discount. Getting 20 years of fees for free because of this discount. I mean, that's some of the way that I think about it. I've personally bought a lot of shares in Bruner. I've always put in important that I'm invested alongside our shareholders. I ride in the shoes of shareholders.
So on that note then, Julian, is there anything else you'd like to say?
No, not particularly. I mean, I think I'd just like to take the opportunity to reiterate what we've talked about. So the all-weather global and UK equity portfolio tries to balance quality, value, and growth. Really good track record, a 51-year record of increasing the dividend. Investing alongside a family that have probably the same financial aspirations as you or I. An all-weather fund that we think you can buy and hold without having to worry too much about your own personal asset allocation. That's really what we're trying to achieve. We think we're invested in some terrific businesses that throw off lots of cash, which we think should grow under most circumstances, which we think are very reasonably valued. So all I would like to do really is reiterate that message. And I'd like to thank you for your time.
Thank you very much.
Right. Goodbye.
Bye.